Gabe Wilcox here from ScaleView Partners, the Austin investment bank for tech founders by tech founders. Speaking today with Brian Alford from Optimal Counsel. Hey, Brian.
How are you doing?
Doing great. How are you this morning?
Very good. It's slightly cold here in Austin, but more, appropriate for December weather than the 70s and 80-degree weather we've had in the last few weeks. So
That's
I'm
right.
enjoying it.
Still might have the 80-degree Christmas. Plenty of time for a comeback.
Mhm.
Cool. Well, to start, Brian, why don't you tell us a little bit about yourself and your firm? Because I know you're relatively new in the market with Optimal. So we'd love to hear about the firm and your focus, and then we'll kick it off from there.
Cool. So Optimal Counsel is a corporate boutique firm that specializes in high growth companies. We represent a lot of tech and CPG startup companies and other high growth companies. Most of them venture capital backed. So we do a lot of VC deals, but a lot of our clients aren't venture capital backed. And we kind of do deals in the early stage 250K range all the way to the $500 million exit range, and really represent the companies all the way in between on all their corporate transactions. And then we loop in other specialists as needed, whether it's labor counsel or regulatory counsel, including in those deals if we need to loop them in. I'm one of the managing partners of Optimal Counsel and one of the founding partners of Optimal Counsel. We're all over the country, all working remotely, very efficient business model, and very affordable rates compared to the big law firms. But we pay people the same or more per hour as they would make at big law firms. So we attract the top talent. We poach from the best big law firms to build our stack.
Awesome. What about, I think it's really cool that you have that full cycle approach with companies, from the early stages of even company formation all the way up to a big exit. Is that typical, or is that something special to your practice? And I would imagine for the attorneys who join you, that's a really cool thing to be a part of too. That must be an attractive thing compared to maybe a big law machine.
So, a lot of companies, I think, form on Clerky or Stripe Atlas or Gust Launch. Those are fine platforms. Clerky in particular, I'd say, is probably, the Y Combinator backed company. So a lot of Y Combinator companies start on Clerky. As soon as you hit a, financing, I think it's really important to switch to more sophisticated counsel than no counsel specifically. And so as a big law firm, you really can't, get involved until Series A stage at the earliest. Sometimes companies will do it as a loss leader, but they're not really prioritizing those companies. We specialize in those companies either at formation stage or at first financing stage, and it's really fun to see them all the way to exit. And I think that is a limiter of some of the other boutiques, is that they can't scale up to the exit. And so a lot of those companies will switch to a different firm at the exit. We have an M&A group that specializes in, representing companies selling to larger acquirers, as well as buying, smaller companies as well. They're all pretty much private transactions, so we kind of specialize on private transactions. But in general, the fewer lawyers that touch your cap table, the better. So it is, I would recommend, good to have corporate counsel as long as possible until you really need to make that switch, and to get them involved if you can at the very first financing.
Okay. That's an interesting one that comes up. As a banker, we get that question sometimes from prospects or clients that say, I've had my company counsel forever. It maybe is the group who helped me from day one, forming an LLC and getting a basic operating agreement. And now I have, this big company, and specifically I'm looking at a transaction, can I stay with the group I've worked with this whole time, or is there really specialized knowledge that comes into play? What's your take on that?
I mean, so I can't, count the number of times for any particular company where we say, we're putting this in place now, so when you raise financing, the investor isn't going to think it's too strange, or we're putting this in place now so that when you raise financing, it may be revised to this, but you'll keep as much as you can in place, So like, we're going to address your goals in a way that's most likely to stick around through the financing.
Yeah.
So, in general, you want people with that longer term view, especially when it comes to like LLCs and what you put in your LLC agreement. A lot of LLC agreements are not built for scalable companies. So if you want to be an LLC and you want to scale your company, I think it's really important to like not just pull something from LegalZoom. I love LegalZoom. They do have some good lawyers there. And one of my great friends is at LegalZoom. So try to find a lawyer there if you are scaling your company, and they may point you in the right direction as well. But yeah, like there's a pretty natural transition from kind of small company lawyer to startup lawyer, and a startup lawyer implies high growth. And the small company lawyers are great if you're not trying to scale. As soon as you're trying to scale, you need to be thinking long term, and how is this going to impact my future financing? How are these going to impact diligence, and would these be red flags in diligence?
Yeah. Yeah. And we often, I mean, I like the line, and as a founder, I could appreciate the idea that you want it's sort of scary to try to find the right attorney for your company, and you want to find somebody you really click with and trust, and that relationship grows over time. And so the last thing you want to do, and I get this, I think the last thing founders often want to hear before a sale process is, well, we need to sort of find some new counsel who has specialized knowledge on M&A, because your corporate attorney is probably great, but this is a different thing compared to sort of helping you with a little contract review and helping you with some HR stuff. And so I think that, but we often have to recommend it. We say, they're great, they can continue to help on things like that, but we need someone who has experience in M&A. And so I think, the way you describe your firm that you've built is that you've got both, right? You've got the ability to be that long-term partner to the company, but you also have a specialized M&A practice. So, when it's sort of time for deal stuff, you've got that resource in-house too.
Yeah, and we also are fine to work with your prior counsel, especially with respect to like contract review. If you want your prior counsel to still help with the commercial contracts, totally fine with us. By not being a big law firm, we don't need to do everything. We do the stuff that we specialize in.
Awesome. Okay. Well, let's talk a little bit about, since we started talking about deals, be it M&A or investment rounds for a company. What are some, let's talk about the kind of the negotiation and the deal dynamics, because you've been a part of a lot of that. What are some tips for founders about negotiating with an investor or a buyer? Some tactics you're likely to see from them, some tactics you might employ yourself to get. And we always say this too, right, to our clients: it's to get the best deal that you can, but it's also to get it's to get the deal done. So it's kind of optimizing terms and also optimizing for certainty of close. They both matter a lot. So with that frame, tell us a little bit about some things you've seen.
Yeah, and so I'm gonna hear this comment is focused on like the fundamental economics, not the, my lawyer thought we should do this and no one was thinking about it, off the wall kind of term. That kind of digs into the weeds and is just kind of a 1% risk reduction mechanism, but more of the fundamental economics. And this is very common amongst founders, specifically the less experienced founders. They approach a deal, they see a big number, and they're like ready to sign on the dotted line. And so my high level point is, I've never seen a deal die because a founder or a company asked for something, especially if it's within the realm of reasonableness. And I can guarantee you, whatever you're asking for is not crazy relative to what that buyer or investor has seen. If we're your counsel and we say, this is something that people ask for, someone has asked for something wildly more ridiculous, and that buyer or investor has seen something wildly more ridiculous. And so when they come back and say, I can't believe you asked for that, no one ever asked for that, they're probably lying.
Yeah.
And so, I've never seen a deal die because of that. That doesn't mean that, you should die on that hill, but don't be afraid to ask. And on the flip side, I cannot count the number of times that founders or companies have not asked for something because they thought it would upset the investor or the buyer.
Yep.
And, the investor, the buyer is kind of giving them the impression that this is the best deal you're going to get, or I'm giving you better than the best deal you're ever going to get. Those are standard tactics by an investor or a buyer, and they're usually expecting you to ask for something. When they give you an offer, they're expecting you to ask for something. So thinking of it a different way, let's say you're a CEO and you have a larger company and you go to a founder group of a smaller company and you say, listen, I think X is the greatest deal you're going to get on the market for your company. And I'm going to beat it by 10%, or I'm going to beat it by 15% because I love you so much and there's so much synergy and we're going to build something great. And I'm so excited to get this deal done. And then the founders are like, okay, CEO, we love you. We love your business. We're super excited. We can't thank you how much, we can't appreciate how much, or like, we can't tell you how much we appreciate your interest, your offer, your level of excitement. And we're going to go to our board and we're going to go to some of our larger stockholders and we're going to discuss this offer. And we're going to get back to you as soon as possible. If that CEO is disappointed in that response, then that CEO is effectively selecting for gullible, inexperienced founders who are probably shirking their fiduciary duties as directors and possibly hiding something. The founder who signs on the dotted line is either gullible because they believe this CEO that this offer is 15% above anything else they're ever going to get in the market, or they're inexperienced. And those usually correlate, gullibleness and inexperience. And sometimes people are experienced and yet still somehow gullible. Or they're not thinking about the fact that they have a duty to all stockholders to get the best deal. Or finally, there's some issue at the company that only they know about.
Yeah.
And they just want to create deal momentum so that when that thing is found out, the deal will still hopefully close.
I like the idea that this sort of lowball, investor tactic might be a bad one, might actually even be a bad tactic for the investor, because you get this adverse selection where you only get, companies where there's something extremely wrong, under the hood.
Sure.
So, it's
well,
like
if you're an investor and they sign on the dotted line immediately, that should be a red flag.
Yeah. I like that.
So it's just it's kind of funny. I mean, what the CEO should want is for the founders to go back and evaluate the deal and ask for something reasonable in return, and they should be expecting it. And this goes a little bit into founders wearing different hats. You're a stockholder, and you may see the dollars that you would make as a stockholder, and that may impact your thinking. You're an executive, so maybe you want to close that VC deal and get back to building the company immediately because you're tired of spending 3 months, missing some sales because you're chasing investment. But you're also a director, and you could get sued as a director for not satisfying your fiduciary duty to stockholders. So you got to put that hat on as well. And I've got to go back to my board is a good way to take a beat, take off your executive and stockholder hat, put on your director hat. And even if the board is you, at least that moment of taking a beat can help you evaluate the offer from a different perspective.
Really good stuff. And the different hats thing is tough, particularly in a closely held business where the founder might be, the major shareholder, but not the only shareholder, then it, can be pretty tough to navigate that appropriately and understand that, yes, shareholders' interest is a lot aligned with my interest, but not just, right? Not totally, it's not totally just my show. We have other people on the cap table, and so you have other responsibilities. I mean, we've seen that dynamic a lot when you talk about the negotiation side, where we often get hired, as the investment banker, we often get hired when there is an offer on the table. That's, because for many founders, that's the first time they've really thought about selling the company. They're just execution machines. And then someone comes in with an unsolicited offer, and that's the first time they really take a step back and say, whoa, maybe this is interesting. But there can still be an
and
aversion.
it can be a very impressive number to them. They're
That's
like,
right.
all of a sudden,
that's right.
What can I buy with that? Like
Absolutely.
all of my problems could be solved for life. Oh,
Absolutely. Right. And so there's a tendency, right? There can be, even among, really sophisticated founders, there can be a tendency to want to be a little bit less aggressive and be very protective of what you think is the offer on the table. And even when it comes to hiring a bank, sometimes we hear a little, well, help me understand this. Will this sort of alienate the party that's here today? Well, what might we lose the offer? And so I think your advice is really important, which is that, and sophisticated buyers, by the way, we've seen it more often than not. A sophisticated buyer tends to be actually happy with the idea that there are other professionals involved in the transaction who are in sort of the transaction business. It makes the likelihood of actually getting a deal done.
I think it increases odds to close. Yeah. Another thing is, like, when you get that offer, you've gotten a piece of information that you didn't have before. And so going back to the example of the CEO, who's probably a strategic, saying, this is what I think you're worth. I'm going to pay you this plus 15%. Well, you might be thinking, oh, well, that company has some competitors. And I kind of believe that CEO before the conversation that we were worth X, but maybe we're worth X plus 15% or more.
Right.
And maybe we don't know something about that CEO's company and what they're in, what business line they're focusing and targeting on, or what other companies they're looking to buy, or what their competitors are looking to buy. We just got a piece of information, and we should use this new piece of information to motivate our future decision making.
Yeah.
And maybe that means hiring a bank, and maybe that means going out to other buyers.
Absolutely. The other thing that occurred to me is when you talk about making a counter offer, different terms. That to me is another good way to discover information, because if you look at all the different, and here's I want you to kind of expand on some of the important terms in an M&A deal or in a growth equity type deal. But there are a bunch of them, right? And headline price is one, and it tends to be the one everybody focuses on. But there are a bunch of different terms in one of these agreements that matter, and some are also economic in the end, and some are not. But like negotiating on, one of the things we advise, negotiating on sort of multiple terms is another way to discover more information about what's most important to the buyer, right?
Sure.
Maybe they're actually not super sensitive on price compared to what they want and as an employment agreement with you, or maybe they're willing to offer more cash up front, or they're pretty stuck on the cash amount, but they're willing to offer more stock. And so it is another process of discovery. And if you don't negotiate it, you kind of don't learn. But what are some of those kind of factors that a founder should be thinking about?
Well, I mean, I think if there's ever an earnout, then shifting what's that initial closing versus what is that earnout is huge, and figuring out how you can shift, and that itself, to your point, will make you learn a ton about the buyer. But whenever you deal with earnouts, you also have to realize that once you get bought, the ability to achieve that earnout is largely outside your control. Yeah. And it could be because the executive that championed the deal leaves the company after you get bought, and all the I'm not going to say promises, but all of their expectations that they set for you may be different after the acquisition. Normally you get some sort of protection for termination without cause. You get some credit for hitting an earnout if you get terminated without cause, for example. But there's 1,000 other things that could happen after the deal that impact your ability to hit the earnout, and most of them are going to be outside of your control. So that's one thing to just kind of keep in mind as a economic point that few people seem to really focus on. That your earnout should be discounted heavily. Even if you're very confident you're going to blow away the earnout projections, you need to discount that cash pretty significantly. And the buyer's discounting it, you're discounting it. Both parties are putting some sort of discount on that earnout. There's the escrow. That's the big, probably second most important term in a non-earnout deal, which is it 10% of the deal? Is it 15% of the deal? Put into a separate escrow account for 12 to 18 months usually that says, buyer, I'm thinking I'm buying your company as you've told me it is, but to the extent, something hits the fan after closing, or I discover something that was in place before closing that I didn't fully appreciate, or maybe you didn't disclose, or I claim you didn't disclose, then I want to potentially claw back some of those acquisition proceeds via that earnout fund. So you may think you're selling your company for X, but 10 to 15% of that number may be subject to potential clawback from the buyer because of what's called indemnification claims. The buyer wants indemnification, ideally from all risk related to the business, relating to kind of pre-closing period. But it can, the buyer will draft the representation so broadly that they try to cover themselves from basically any risk that might occur over that 12 to 18-month period following closing, to effectively just reduce your purchase price, reduce how much purchase price you get. So that's a huge, that's probably the majority of what the lawyers spend their time negotiating after the term sheet stage, is just, how do we make sure, you get your money, you keep your money, and anything that's in earnout is smaller and you get it as quickly as possible. And as you know, time value of money is important. So the more money you get up front, the better. And then the quicker you can get that remaining proceed and the lower risk that is to purchaser clawback, the better. There's some terms that are kind of off the wall that you see in tech deals, which, I think are a semi-red flag for buyers, like reverse vesting founder stock. I've seen that pop up. I would be a little insulted as a founder if I saw a buyer say, in most deals, the founder stock that's unvested is accelerated. So if you're only vested in 70% of your stock, in most deals, you'd tell your investors and the board, hey, I'm not doing a deal unless I get fully accelerated. And if the buyer wants to give me more to keep me incentivized to keep working for the buyer, they can give me more equity in the buyer as an employee, just like a new hire that you'd give, stock options to, and that can keep me further incentivized. Or maybe there's an earnout that keeps me incentivized, keeps me working for the buyer. But to not accelerate your vesting, that's a tad aggressive by the buyer. But B, actually reverse vest you and say, no, you're not 70% vested. We're going to bring you down to 40% vested. So we really put kind of, I don't know if you'd call that golden handcuffs or what, but like spiky golden handcuffs. Yeah, I've seen those in deals. And so some of those off the wall economic terms, really important to talk to your banker, talk to your lawyer and say, is this standard? Is this not? And push hard against your board too, because your investors don't really care if you get reverse vested in the deal, as long as they get paid. That's what they care about. So just fight hard, make sure you're understanding what the market is. There's other big terms, I'm trying to think. There's like non-compete, you're going to be likely bound by a non-compete that might stretch 3 years after the acquisition. So when you're with the buyer and you realize that you have to stick around with the buyer for like 2 years, and you're working on a new idea, try to make it a non-competitive idea.
Yeah.
If you
Yeah.
can. I'm trying to think, any other big deal discussion, negotiation points that you'd like to talk about more?
Those are really good. Well, maybe we should come back to the reps and warranties. It's kind of, it's in the weeds, but then when when you haven't sort of been through the sale process before, but then after you've done the sale process, you realize, as you said, it's a huge part of what you're working through. First though, I wanted, on the earnout, we talked to, I think, good advice on an earnout. I would feel personally, I would feel similarly, which is that, when you are kind of running your startup, you own a lot of risk, but you have a lot of control relatively about your outcome. And in a sale of the company, for me, I would really only want to be sort of going one way with my risk. And my idea, I'd be selling risk, taking some risk off the table. And so an earnout, unless it's sort of icing on the cake, if you get your number and you're happy with your number in cash up front, and then there's also an earnout, right? Then you say, well, sure, give me the earnout. That's just extra if it works. But if it's not, if it's sort of something that you consider part of the price that you're looking, to get for the company, I don't like that trade, but I would agree with you, because now you have continued risk, but you've really limited your ability to control that outcome and whether you can actually hit it or not. So that I'm with you on that.
And it's a way for the buyer to hit a number that's acceptable for the seller, and
Yes,
take a percentage of that number and have almost no risk on
right,
that percentage, to be like,
right.
hey, I'll pay it to you, but you have to prove to me that this percentage of the acquisition value is worth it. So it's like, yeah, complete risk shifting of that portion of the purchase price from buyer to seller.
Yeah. We talk to entrepreneurs all the time who don't fully understand sort of the different components of deal compensation, I'll say, which is that, so look, cash at close, got it. Simple, easy to understand. Stock at close, also, most people have an idea about it, although there's some nuance for
It's
sure.
private company stock. You better, I don't know. So I've definitely seen deals where the private company stock is represented to be way more valuable than whatever
Right.
their last round was, because it occurred maybe a year or 2 years after the last round.
Mhm.
And just like the earnout, and maybe even more so than the earnout, you got to apply a huge discount to the value of that private company stock. If they just did a preferred stock deal, fair enough. But then you have to dig into the liquidation preferences of all of their preferred stock and the economics of their preferred stock,
Yep.
just to confirm they don't have some highly preferential economic terms for their preferred stockholders,
Right.
which could, if your preferred stock value is at $10 and they're giving you common stock and saying, hey, this is $10, well, you got to apply a fairly hefty discount to internally establish a more appropriate market value of that common stock that you're getting. So that's like point
Yeah.
number one. Point number two is, how long has it been since they've done a preferred stock deal? Has the value
Yep.
actually gone up or gone down? This is private company stock. Public company stock is much more straightforward.
A lot easier to understand, right? So your point is private company stock, what's it worth, right? It's not, you can't sort of go to Yahoo Finance and see what the market's valuing a share at. And more to the point, all shares aren't created equal. What is the company? So what is the negotiation there? You're representing the company. Can the company, can the buyer, that is, if they want to offer stock as part of the deal, are they free to represent whatever value they want on that stock? Do they need to, go by a recent, valuation and a financing or something else? And then you mentioned kind of liquidation preference and other things like that. So you might have to look at what share class you're in. And then what do you want? I think I know the answer to this because I think it's what you got me. But what if you're a founder, what do you want to hear about the stock that you're getting?
So I think maybe it's possible to get preferred stock as a founder, maybe, but it's
Maybe.
likely that the buyers, investors are not going to be keen on the founders getting preferred stock. But if the buyer just raised a Series C round and at a specific price per share, and then they're giving you that exact same Series C preferred stock at the exact same price per share, that's fairly straightforward.
Yeah.
You have to think about whether or not SoftBank was the Series C investor and whether or not that was an appropriate valuation. But otherwise,
right. So the price tag matters, right? Because you're effectively
sure.
you're buying it. You're taking that price. So you do have to think: do I like the company at that price, or was this a crazy kind of number?
But if it's common stock, normally the buyer is going to be trying to treat the common stock as the same value as their preferred stock might be valued at. And so as a seller, you have to apply some sort of discount. There must be a discount because preferred stock has favorable rights and preferences to common stock. So there must be some discount. It may not be that large, maybe everyone can get on board with the buyer being such an amazing company that's so likely to hit a home run that the discount isn't that huge. But as a lawyer representing the seller, I would always try to argue to add a little bit more discount. You're not running the buyer. You're not on the board of directors of the buyer. You don't know. And then there's always a little bit of a tension between, there's the preferred stock price. There's maybe what you might apply as a market discount for the common stock. And then there's the 409A common stock price.
Right.
And so the legal documents may not be able to establish an exact price per share for the common stock because that might make it harder. So a 409A is a tax value. I'm talking to Gabe, so I'm just like assuming that that Gabe understands everything I'm talking about. So the 409A is a tax value of your common stock for the purposes of granting stock options. And you get financial advisors third-party financial advisors to say, if you were to sell your company and look at competitives and look at all these different financial metrics, we think the common stock price is really here. And that allows you to grant stock options to people. And the options are more valuable the lower the exercise price is. And so, if you can get a third party to say your common stock is worth this, then you can grant stock options to people at a lower exercise price and they'll be happier. So the deal documents might not be able to say.
Call that process what it is. It's your goal is to put a low number on it, right? You want to sort of look at all the ways that you might argue that the shares should be worth less.
That's right.
They're liquid and there's a lot of risk in the business, and so so that's the game there. But so you're saying then it might be problematic to have a deal document that says, well, but
that's
actually
a higher price.
They're worth a lot more, right?
And Carta is a typical valuation firm. You might ask them how that impacts what the future 409A price might be. They might be able to say, oh, it's a one-off transaction. We can still apply, all this typical industry accepted analysis to determine a lower 409A price. But that's something to think about. I wouldn't get too bogged down into what the legal documents need to say, but more what is the true discount between the preferred stock price and the common stock price. And to decide or determine what that discount is, you need to also understand what the terms of those preferred stock shares are. And one of, the most basic term of a preferred stock share is in an exit, the preferred stockholders need to get at least 1x back. Okay. And so if you have a not great exit of the buyer and all of the investors who hold preferred stock get at least 1x back, then that means a portion of the proceeds may be taken from the common stockholders and basically shifted over to the preferred stockholders.
Hmm.
And so the common stock might be getting a lower price per share in the exit than the preferred stock price per share.
Mm-hmm.
There are way more aggressive ones, like sometimes it's 2x instead of 1x. Sometimes it's the preferred stock gets 1x back first, and then they get their share of the remaining proceeds. So in every exit, the preferred stock may get a higher price per share. So knowing those economic terms of the preferred stock can help you establish a more appropriate value of the common stock.
Mm-hmm.
And it's incredibly complicated, hard to determine. I guess a banker might be in the best position to actually determine what that common stock might be worth.
Yeah.
Because the lawyers can kind of help you, give you some guidelines,
Right.
but
right.
we're not financial advisors,
Right. So you can explain the mechanism, right? Here are sort of the rules. But then the banker, no, we certainly help the client look at that. The other thing that's interesting about these are all a bunch of, there are some gotchas with taking stock in the deal. There are also some really good things about taking stock in an acquisition. I'll say that, and that's something that wasn't fully apparent to me until I sold my SaaS business and had stock as a portion of that compensation that turned out to be great. Turned out to be, a home run return on that stock. And it was because we did pay attention to a bunch of the things you mentioned. What's the price we're getting in at? What are our rights compared to the financial sponsor and all that kind of thing? And so that's important for it to work out well. But one of the things that we now, I share that experience with some of our clients today, and it's an interesting dynamic, right? It can be, there's a logic to taking a stock component of an acquisition deal that's almost similar to why you would go raise growth equity, right? Which is that you get the chance for 2 bites at the apple. And probably if it's a strategic acquisition, it's likely to be a company that's the buyer is probably relevant to your company, right? That is almost to state the obvious. So it's probably an industry you know pretty well. You're kind of an insider. You have a view on, probably you have a view on that acquirer. And so you should think of it like an investment decision, of any other kind. But it can really be a way, again, I think, to continue to bet on, to a certain extent, bet on your company, because maybe your company is going to continue to perform really, really well after the acquisition and make that acquirer's stock more valuable. But you can also bet on an acquirer, and it can be a way to sort of use the knowledge you've gained building a company in a specific industry to say, you know what, I'm going to take a lot of chips off the table today, but I'm very comfortable with taking stock as part of the deal because it's a way to participate in the continued upside of this business.
Yeah, I think that's right. That brings up to me at least an argument that you should try to get preferred stock in the deal. I think it's unlikely that you will get preferred stock in a deal, but to say, hey, if my company is worth X and I'm basically taking a portion of it,
right,
and reinvesting it back into buyer, what's the difference between, like what you're proposing and you just paying me all cash, and then I just take some of that cash and put it back into your company.
That's
if
right.
I was a investor of cash into your company, you'd give me preferred stock.
That's
so
right.
That's at least an argument.
I think that's right. And we got, this was now a few years ago, but in our, so we the structure, I think the structure was that perhaps everything was in common at the company, but we ended up, pari passu with the backer, and we ended up at a valuation that was, also the same as what the most recent sponsor had done, and so those were important, very important components to it working out well for us. And I would agree. If you're effective, you're saying my price for the company is $100 million. to the extent that you're giving me some of that in stock, I'm basically an equity backer
Investor.
of the company. I'm an investor in the company now. So
And your deal was like more of private equity backed. A lot of my examples are if the buyer is venture capital backed
yeah,
and there's preferred stock and common
yeah,
stock, and maybe multiple tiers of preferred stock and then common stock.
yeah,
If you're getting bought by a private equity buyer too, that goes back to your point even stronger, because almost always if you're bought by a private equity buyer, you want multiple bites at that apple.
right,
The private equity buyer is going to say, here, take 70% of the chips off the table, roll 30% over. So basically take 30% of your acquisition proceeds and roll it into stock in the surviving entity. And then we're just going to sell this company again in 3 or 4 or 5 years. And
right.
you may be able to get a much higher multiple on that same equity. And we're also going to lever it up with a bunch of debt. So it will be a high risk, high return
Right.
equity.
No, it's and again, it goes back to evaluating it as an investment decision. You should look at the firm and try to understand their track record, and but there are some very good private equity firms, and they tend to be in the sort of 3x business, and so to the extent that there are scenarios where rolling some of that capital forward in stock is a pretty good bet for the founder. So look,
Can I just, on that rollover real quick, can I just add that
yeah,
both a secondary in a venture capital deal as well as a rollover in a PE deal are a mechanism by many sophisticated investors to incentivize the founders to swing for the fences, because they've de-risked themselves. Hopefully they've taken what is, maybe 90 or more % of their wealth and now can diversify it into other asset classes. And now the smaller piece of their wealth, they can now be much more risky with it.
yeah, no, it's a really good one. I was on the growth equity investment side of things earlier in my career, and that's a logic to kind of growth equity type minority investments that I think makes a ton of sense. It can be very hard to leave aside like swing for the fences. I would say that it's really easy for founders to become too conservative with the way they run the business when they have 98% of their personal net worth tied up in the company. You take a lot of risk to start it and grow it, but to really keep the appropriate level of risk on can become harder and harder when you build something of value and you're not diversified out of it.
That's kind of what I was trying to get at. Exactly.
Yeah, really good point. Well, to go back to earnout quickly, we talked to a lot of people who don't fully understand sort of the different types and timing and guaranteed versus non-guaranteed, like just the different types of compensation for a deal. So maybe we can go through that. I'm sure you've seen it all. The escrow point was a good one because that's sort of cash up front. That's not really quite cash up front. It's cash a little bit later because there's escrow. But the difference, for example, between earnouts and just delayed payments, do you see that in some of the acquisitions you work on where there are payments that are guaranteed but delayed in some way?
So let's take the simplest deal would be, all cash, let's say 85 to 90% of it at initial closing, 10 to 15% of it in an escrow that pays out 12 to 18 months later.
Mm-hmm.
And so the 12 to 18 month period is sort of the buyer being like, well, I hope I uncover all of the BS relating to this target company within that 12 to 18 month period. And at least I can, address 95% of my risk by trying to flesh out all the issues during that 12 to 18 month period.
Right.
So that's sort of the basic, maybe simplest deal for selling your company. Then you've got an earnout, and it's a little, I guess I'll avoid the topic of how does an escrow relate to an earnout, because if a buyer's asking for an escrow and an earnout, then you can be like, hey, what are you doing? You're already protecting your risk. if there's an indemnification claim, if there's an issue that you uncover, just take it from the earnout, like you don't need an escrow and an earnout, or you can use the earnout to argue for a lower escrow. And so let's just not get into those weeds yet. The earnout is basically, let's take a percentage of the acquisition and say, a year later, 2 years later, 3 years later, I don't have the deal data in front of me, but I'm pretty sure like most earnouts are like a 2-year time period.
Okay.
If you have an earnout that's beyond 2 years, I think that's relatively uncommon. So I think most earnouts are kind of 1 to 2 years, and often it's revenue targets. We see EBITDA targets. Sometimes we've seen founders sticking around milestones. Sometimes we've seen tech integration milestones. So, there's milestones and there's earnouts, but they're kind of similar. You have to hit certain expectations to get certain payments. An earnout usually can be different in that sometimes there's no cap on the upside. And that's pretty interesting for sellers. You can continue to get acquisition proceeds to the extent your EBITDA keeps going up. And I think that's usually EBITDA based, because a buyer is going to be way more comfortable with an uncapped earnout if it's profitable.
Right.
If it's just like revenue based or some other milestone, they probably are going to want to cap that earnout. But the high level point is that you've got some percentage of your purchase price that you have to earn through either milestones or financial metrics post closing. And it could be users, if revenue and EBITDA is not as relevant, it could be based on user growth, or maybe contracts. It could be based on monthly recurring revenue, annual recurring revenue. Think of every financial metric you can think of, and that can play a part in an earnout.
Got it. Or non-financial, or there's the sort of just show up. You've got to show up. You've got to not get fired for cause. there's that one too, right? Just kind of tenure based.
And that's kind of similar to my reverse vesting topic of just the founders having to stick around, is basically like reverse vesting.
Yeah.
To say, the acquisition proceeds that go to the founder, I guess sometimes you can say the acquisition proceeds that go to everyone are contingent upon the founder sticking around. And that's a good way to get your investors aligned with you on pushing back on that term. Is to say, we as founders, we may agree to part of this, but we want everybody on the hook for it.
Yeah. Yeah, I like it. I like that. Really.
So those are the kind of the big deal buckets. One point that you mentioned was reps and warranties that kind of impact the escrow, for example.
Yeah.
And just so we don't, forget about it for tech companies, there's a concept of kind of standard representations and fundamental representations. And the standard representations are like all of the normal operations of the business, and those usually survive for 12 to 18 months following the closing.
Okay.
And so when you make a representation about your business, it's like, we have these top customer contracts, and we're not aware of anything in writing that might jeopardize these customer contracts, or something like that. That may be a representation that you might make. That would be in the general representations bucket. A fundamental representation might be, we own the company. These are the people who own the company. And the buyer's like, you cannot ever breach those fundamental representations. There's no excuse for ever breaching those fundamental representations. And those might survive for 5 years or 6 years after the closing. So that if we discover 4 years down the road that there was a 5% owner of the company that you didn't disclose to us, we can actually, even though we've released all the escrow money, we can still go and sue you for some of the money back, because there's an owner of the company that we didn't realize, and so we're going to take 5% of what we paid you and give it to this guy, and also we're going to tell you got to cover our legal fees. So that's fundamental versus your regular representations. Your regular representations, hopefully after 12 to 18 months, you don't have to worry about any breaches of those.
Right.
But
Because
what
that's when you say survival, it means it's sort of timed out. Like if you
yeah,
12 months to make a claim or 18 months, and after that, that's it. We're done. Versus the longer period for something fundamental. Taxes tend to be like that, right? If you owe
taxes are fundamental usually, yeah.
yeah.
What the buyers in tech deals try to do is they try to take intellectual property and move it from regular, which is where it is in most deals, and move it to fundamental or somewhere in between. And that can be an issue because the big one that gets negotiated in tech deals is like, okay, well, we've never had a patent troll, we've never had a patent infringement claim, but once we get bought by you, mega company, and we're blasted all over the internet as this deal closes, and a patent troll pops up, that's not our fault, that's because you big buyer bought us.
Right.
Now, it kind of goes against my argument because hopefully you'd imagine that would fall within the 12 to 18 month period post closing. But the point being that sticking IP into a fundamental rep that lasts for 5 years or 6 years post closing can be a very material risk for the company. So thinking about those survival periods is very important. And in tech deals, there's different market terms and different things people negotiate, and it's good to get lawyers that are used to negotiating those things.
Got it. Really good one with respect to IP. How about, let's for the remainder of our time here, maybe talk about the market today, get a little bit of kind of current market commentary. It's been an interesting year. I'm sure you would agree. But tell me a little bit of some of the dynamics you've seen. What's different, if anything, from a year or two ago, and what are you expecting for next year if you want to prognosticate?
I don't know if there's any upside for me prognosticating, and Gabe, I bet you can do a better job of it. But in the current market, I think valuations are lower, multiples are lower. In general, you've got, public company valuations, and then private company valuations track those or correlate to those to some extent. And those are usually private company exit valuations, not private company Series A, valuations. So,
Right.
When you get to a Series A deal, especially if, Series A valuations correlate less with how much revenue you have. And in large part, we're talking about, software companies here.
Yeah.
In an exit, it's oftentimes a revenue multiple, and it's oftentimes correlated to your public company competitors.
Mm-hmm.
And so if the public company valuations come down, the private company valuations come down as well. But if you were to compare that to Series A, there may be kind of a informal revenue multiple going on at Series A,
Yeah.
but usually not. Usually Series A valuations fall in a certain valuation range, and they're not closely tied to revenue multiples. As you get to Series B and Series C, they start to become more correlated with revenue multiples. So because public company valuations have come down, all valuations have come down. And I see a lot of companies trying to extend runway to hit a point where valuations come back. That's probably the most common recurring theme is let's extend runway. A lot of companies have paused hiring or reduced headcount to extend runway. And a huge part of that is risk reduction, but also just let's get to a point where valuations are at a place where we're happy. Because valuations are not super great right now, even though there's, I think, tons of money out there trying to get in on these lower valuations, trying to poach these lower valuations. So it's a struggle between people trying to take advantage of the lower valuations and companies trying to not have to take a deal at a valuation they don't want to take.
Got it. Yep. So why transact in a market like this? Because people do. You know, what is the appeal? I mean, is it sort of we're off the, you know, last couple years, maybe crazy numbers, but not far off historical trend lines, and so there are still fair deals to do? Is it maybe a growth equity type deal becomes a little more popular, where you get a little bit now but maintain some upside for later, when maybe things are frothier again? You know, what do you see driving deals getting done, and what do you see, to the extent that deals are still getting done, where it's you know, disconnected from the public market a little bit? You know, why is that? Are there companies that are super strategic, or the growth rate can be higher, or are there reasons that people are still paying up?
Well, you know, I think a lot of it, even if a company is really hot and shouldn't have any discount to their valuation a year ago because they're just killing it, it has a lot to do with leverage, and investors and buyers still know that they've got more leverage than they did a year ago.
Mhm.
So those hot companies still want to raise money and still want to grow. You know, I think that a lot of companies don't want to really hit the pause button.
Yeah.
So the really great companies still want to keep growing, still want to raise money. They want to have a good plan in place in case, you know, the market keeps turning down, or in case their performance doesn't meet expectations. I think there are a lot of companies that have very enthusiastic existing investors,
Mhm.
and they might be inclined to do like a bridge round, where it's maybe a discount to the next valuation as opposed to a valuation today. So I think a lot of companies are pursuing transactions like that, where they're like, hey, you know, you know, if you get your money in now, we'll give you a good discount, and you'll be protected, because if the next round isn't great, you'll still get that discount, or at least you'll still get the highest you'll go is at least that next round.
Mhm.
And if things go really well, you have your discount to give you your value for investing early. So it'd be a convertible note or a safe that converts into the next round, and often it's, you know, largely insider rounds for companies that are still very exciting, and it balances the concern of the existing stockholders to not take money at too low of a valuation, with the, you know, interest of everyone to keep putting more money into the company, and the investors to make sure that they still get a good return. So I'd say that's fairly popular, and that's one of the reasons why people want to raise money. Other companies are saying, you know, 6 months, 9 months is okay to kind of put the pause button on, and we don't want to raise more money. We just want to extend our runway. So companies that are, it makes sense to them to press pause for 6 to 9 months, that's the route they're going. You know, I think there's always going to be companies that are super hot, where the valuation isn't going to be as correlated to public markets or anything.
Yeah.
You know, it's purely a function of so many investors wanting to put money into their company.
Yeah. Yeah. Supply and demand. Great. Well, how about we wrap up with a quick sales pitch from you for Optimal, or at least, you know, let folks who are listening know what's sort of the right type of client for you. When can you help? When should somebody get in touch with you?
Certainly. If you're a high growth company, definitely reach out. Either you're a high growth startup just forming, or you're a company that's looking at your first financing, or you're a company that has been jaded by big law and their slow response times and failure to prioritize you because you're not worth $500 million yet. We're a great fit for any of those companies, as well as any company that's exiting anywhere from probably 5 million to 500 million. And so we kind of overlap really well with the companies that you're working with in terms of exits.
Yeah.
And if we're not the right fit, I'll try to help you find the right fit, you know? And if you hit $1 billion valuation at some point in your company's life, and you transition to big law, I'm okay with that. And maybe we can still help you buy other companies, because we have a lot of larger companies. Well, we'll help them acquire other companies that are more in our deal size range.
Awesome.
And if you go to www.optimalcounsel.com, you can also email me at Brian, Brian, at optimalcounsel.com, or just Google Brian Alford, lawyer, Austin, and you should find my my LinkedIn and my bio.
Very good. Brian, thank you for the time. Educational, entertaining, as always. We may have to follow up on some of these other deal points. But thanks again.
Thank you. It was really fun.